Welcome to Subramani. Today I'm going to talk to you about retiree portfolio and the impact of 3 I's on your portfolio. This is you have to be worried about inflation. You have to be worried about the infrastructure spending, and you have to be worried about the interest rates. Now, interest rates and inflation are obviously connected. So, if inflation goes up, interest rates are likely to go up. So, what will be the impact of the interest rates going up on your portfolios? You have to see. If you have a very long portfolio, my debt portfolio is a very long portfolio. I have a 19-year maturity product, and obviously the impact on that will be higher, but it will be lesser on an ultra short bond fund or a short-term income fund. So let us look at each one of them. Inflation in the US in 2021 at least mathematically seems to be higher than it was in India. Fed is talking of 7.5% and RBI is talking about 4%. I really don't know much about what inflation central bankers talk about. You have to calculate your inflation. You write down your expenses, you will know your inflation. So if your inflation is 11%, then you have to be planning for 11% inflation, not for 4% like what the RBI says, or 7.5% like what the Fed says. Both of them are irrelevant for you. Check out what is the inflation impacting you. You need to be protected against that, right? So that is what is important, and that is for your intermediate and long-term portfolio. Your short-term portfolio may just about manage to equal inflation. For example, if you have money in ultra short bond fund or even a short-term income fund or any of those funds, you are not likely to get more than 5-6%. Assuming that in India inflation is 5-6%, that's fair. But if assuming inflation in India is 8% and you are getting 6%, then it's not fair. Also because you will pay at least 10% tax on your bond funds, right? So be worried about what is the real return you're getting, which means return minus tax minus inflation. That is the number that you should be targeting when you have inflation. Now, inflation was almost not there in the US, and therefore interest rates were at very close to zero. And at some points in time, it may have even been negative, like it was in Europe. So you have to understand that interest rates will go up in the US in the year 2022 and forward. At least it will go up in 2022. Now the thing is, let us say the Fed raises interest rates and the market comes down and the economy doesn't take off. Our Fed is today very, very what I would say scared. RBI is not so bad, and they'll immediately go back and start reducing interest rates. They're capable of doing that. So you have to be sure that interest rates will change, but don't be sure that interest rate will always go up. There will be a time when, because interest rate goes up and the market is not responding to the stimulus of the Fed, the Fed may again start their zero interest regime, right? That is one possibility. Second possibility is, neither the Fed nor the Reserve Bank can influence the interest rate at the longer end. Whatever they try, whatever they do, because longer end demand for money, longer end rate of interest is met by demand and supply of money. So if there is lot of demand for money at 7%, then the prevailing rate in India will be 7%, not 5% if the government decides, or 11% if the individual decides. So you will get a rate of return which is very close to inflation, plus or minus 1%. Right now, you're getting negative interest rates in US, you're getting negative interest rates in India, at least in the shorter end of the curve. So you need to know how to handle inflation. If you have longer bond funds, obviously the impact will be greater. When interest rates goes up, your portfolio will fall higher. So that is one thing about inflation. Second, interest rates will change. Third is the infrastructure. Why am I talking about infrastructure? Because in 2021, Biden has signed a 1.2 trillion, let me repeat, 1.2 trillion dollar budget for spending on infrastructure in the US. Now that is high. Also, if you see the latest Indian budget, the government of India is borrowing money for investing in infrastructure. Huge amount of infrastructure spend is going to happen if you look at the current budget. The government is let us just look at UP government. UP is the chief ministers prior to Yogi added something like 200-300 kilometers of expressway and highway, and Yogi ji is adding about 2,300 kilometers. Now I'm not supporting or canvassing for BJP or for Yogi, but I'm saying the kind of infrastructure spend happens only out of the budget, which means it has to come from higher taxation, which means you will have lesser money, or it has to come from printing more notes for the central government or for the state government for borrowing, right? So now borrowing also increases your interest rate burden, whether it is the central government or the state government. So inflation will be increased because of the infrastructure spending. I am not saying government should not spend on infrastructure. It is much better for the government to borrow and spend on infrastructure rather than borrow and pay their dearness allowance to their employees. Definitely it is worthwhile in the longer run to spend on infrastructure, though I am personally I wouldn't mind even if the money was to go only to the employees, because that also comes back into the economy. So it's not really bothering me too much, but you have to be worried about the amount of money being spent on infrastructure, because when infrastructure spend goes up, it goes out of government budgets. That will again stoke inflation. So infrastructure spending will lead to inflation, and that will lead to higher interest rates. Now when it leads to higher interest rates, maybe you will be very happy because you are a fixed deposit kind of a person, but fixed deposit interest rates just about match inflation and they don't provide for taxation. So if you have 6% if you get 6% interest from State Bank of India and you are in the 30% slab, 2% is gone to tax, so you're left with 4%, and if inflation is 7%, you are already on -3. So bank fixed deposit is not a great idea for your bucket number 2 and bucket number 3. Bucket number 1, where you should have expenses at least for 2-3 years, 4 years, 5 years, that should be that will have some fixed deposits, etc., but that should not be a very big amount, simply because it is not tax efficient and it is not protecting you against inflation. You are actually better off keeping money in an ultra short bond fund, maybe 2-3 funds after the Franklin Templeton episode, from which you can withdraw after 3 years and be paying less tax. So if you have 3 years expenses, 5 years expenses, whatever in bucket number 1, make sure that you start withdrawing only after 3 years to make it more tax efficient. Your bucket number 2, which is got some kind of inflation adjustment, some REIT, and maybe you have everything anyways in growth options, so you have inflation, you have balance advantage fund and things like that in bucket number 2, some element of equity and some element of debt. And in bucket number 3, you have purely inflation adjusting things like real estate or equity with large standard deviation. All that is in bucket number 3. So the way to handle the 3 I's, which is inflation, interest rates and infrastructure, is to make sure that the quantum of money that you have in bucket number 3 is high. But the way to reduce risk is to say, okay, now that the markets are doing well or not doing too badly, let me do my monthly withdrawal from bucket number 3, because that way I'm reducing my equity exposure. Also, what is happening is my bucket number 1 is growing because I'm not withdrawing, and even if I withdraw, maybe after some time if the market comes down, I start withdrawing. But I had kept only 5 years expenses, now that has become 7 years expenses or 8 years expenses, because I've been withdrawing from bucket number 3. So this is one way of tackling your interest, inflation and infrastructure spend. And because infrastructure spend is going to lead to inflation, inflation is going to lead to increase in interest rates. One more thing which is when infrastructure spending goes up, there's a good chance that if you buy shares if you hold shares in your portfolio which are into cement, steel and maybe other metals, and maybe real estate companies, maybe a piece of real estate, because during higher inflation times these are the assets which will do well. So you are participating in the higher inflation by participating in real estate, and you're participating in the economy by buying assets which are less interest sensitive and more towards providing inputs for infrastructure. So maybe some infrastructure fund, maybe some good companies on infrastructure, which are not just too many, or simply buying more of the core material like steel, cement, etc. But beware, we are at quite a high of the commodity cycle also. So temper all this knowledge and build your portfolio. Thank you.